Hello, everyone, and welcome to our review of the chapter for liabilities. So here's what I think the breakdown for the final exam might look like. Firstly, expect a question on financial statement analysis, statement of cash flows, equity, liabilities, property, plant, and equipment, allowance for doubtful accounts, revenue recognition, and inventory. Now, this is an absolute guess. I'm basing this nothing except for generally what I've seen in the past and just going through the syllabus and assuming which questions would require a long answer question. This is what I would guess it would be. Now, today we are focusing especially on this liabilities part right here, in which, so liabilities questions are weird because it has a lot of small parts. So it is possible that instead of it just being a pure liabilities question, it could have adjusting entries in it as well. Or some of these parts, for example, there could be a question, a multiple choice question on warranty or CHST. All of these are small topics. You can even expect multiple choice questions from here, or a liabilities question, long answer question, or one with adjusting entries. So let's go ahead and try some of the questions that are some of the liabilities parts that we could expect to see. So we're starting off with a warranty question to begin with. So this is a sample question. So this company sells laptops and they sold 50,000 units of this laptop. And there are two kinds of warranty claims. There are either minor warranty claims, which account for 4% of the laptops and cost $150 each to repair, or there are major claims, which costs $400 each to repair and account for 2% of all the laptops that are sold. And at the same time, they also told us what is the actual cost incurred for warranty claims. So going down to the option, this is a multiple choice variant of the question. It gives us several different options. It asks us whether the warranty liability at the end of the year would be 300,000. Would the warranty liability at the end of the year be 400,000? Would the warranty expense for the year be $300? Or would the warranty expense for the year end be $400? So first of all, let's calculate how much the warranty expense would be for this project. And then we can also see what the warranty liability balance at the end of the year looks like. So it tells us we've sold 50,000 units. So let's go ahead and write that. 50,000 units sold. And when it comes to the minor repairs, each repair costs $150 per unit. And it accounts for 4% of all laptops sold, which is 4% of 50,000. At the same time, major repairs cost $400 per unit and account for 2% of all laptops, which is 50,000 sold. So let's see what this 4% and 2% correspond to. Let's do the math on that. So 4% of 50,000 comes to 2,000 units, which means 2% will come to 1,000 units, right? Or we can even do that math. Perfect. Now let's see what the minor and major damages are estimated to cost us in total. So 2,000 units, each one will cost us 150, 2,000 units into 150. So let's do that. This portion will cost us $300,000. And 1,000 units, each of which will cost us $400, gives us 400,000. These are dollars. So the total amount that all our warranties are expected to cost us is $700,000. Now remember, when it comes to warranty, the moment we made the sale, we immediately recognize the warranty liability at the same time. So our journal entry would have theoretically looked like this. We would debit warranty expense and we would credit warranty liability. And the amount associated with it would be 700,000. Okay, so now we know how much the warranty expense for the year was. It was 700,000. But here the only options tell us 300,000 and 400,000. So we can eliminate these two. It won't be any of these options, which means now we need to go find what's the end balance of warranty liabilities. So let's remember what the T table looks like for warranty liabilities. So we've incurred this and we made a credit here. So let's put in that balance. And at the same time, the question tells us that the actual cost for repairs ended up being 300,000. It wasn't 700,000, but for that particular year, it ended up being 300,000. So let's put 300,000 now. So now, so basically for this, just to cover it, the journal entries that would have been involved is a debit and a credit. So the debit would be to warranty liability. And the credit would have been to cash or inventory or some other thing that if the question tells you, you'll know. And that's why you can see we debited out this amount. So the moment we the moment we make a sale, we immediately set up a warranty liability account and incur the expense right away. And then gradually, as people bring in stuff for repairs, we'll keep debiting those things out from here. We'll keep debiting these items. So now that we know these are all the journal entries that are involved, let's see what the end balance is. It ends up being 400,000. So our end balance for warranty liability is 400,000, which means option B is the correct one. So fairly straightforward. When it comes to warranty liability, remember, the main thing they're testing you on is whether you know that you're incurring the expense right at the beginning. So the moment you start off, there's a tendency to see the actual cost of warranty to be 300,000. You'll be like, oh, warranty expense for year 3 should be 300,000. That's the right answer, right? But that's not how you do it. The warranty expense is incurred at the start when you make the sale. So you have to calculate how much warranty liability you're setting up, which is this figure. That is your warranty expense. That's your warranty expense. And then anytime someone comes in for a repair, you're debiting some amount out of the warranty liability, and then you find the end balance for it. That's how warranty is solved. Let's go on to the next part. The next part is HST. So when a business makes a sale on HST, let's see what the journal entries involved are. So whenever you make a sale, normally there's a debit to cash and there's a credit to revenue, right? This is what it will normally look like. But at the same time, you're also charging the customer and collecting on the behalf of the government, the HST amount. We can just call that an HST payable. So let's see what the amount is. So the revenue is how much you're actually selling it for, which is 25,000. Now the HST amount will be this, is 10% of this, which is 2,500. And you add the two up and that's how much cash you'll be collecting. That's your first set of journal entries. If any of you have gone out and done groceries, your bill will pretty much look like this. When you pick up the item from the shelf, it'll tell you it's worth this much, but then they add a certain amount of HST to it. But the amount of cash you end up paying is this amount, right? So that's pretty much how it works. Now let's look at the next part. The product cost of business, 18,000 to acquire. This is your cost of goods entry. So debit, credit. Your debit is cost of goods sold, and your credit is inventory. And it's 18,000. Right? Easy now. That's what these questions will look like. And this is HST payable. This is how much you have to send to the government. But also remember, it's not part of this question, but a lot of questions may also have HST receivables, which is any HST that you paid on inputs. So any HST that you've paid in order to produce the goods will be refunded to you by the government at the end of the year. So say that you had some kind of a bill. So let's assume it's an electricity bill. For an electricity bill, which you paid off, and that was for, say, $100, right? And again, when you got the HST, when you got the electricity, you got charged 10% HST on that. So at this point, you would have put down an expense. So you would have put down utilities expense, and credit, say you paid it off right away, is a credit to cash. But at the same time, you also got charged HST on it. So your utilities expense will be $100 here. That's how much you incurred. And the amount of cash you had to pay was 10% of this plus 100. So that's $110, which means you have an HST receivable of $10. This amount, once you make the sale at the end of the year, the government will give you back this amount. So the amount you have to pay to the government will be the 2,500 minus the $10, and that's the amount you'll have to remit to the government at the end of the year. So remember, any HST that you pay on inputs gets refunded to you at the end of the year. But at the same time, when you make sales, you'll collect HST on the company's behalf. Let's go to the next part, which is loans and notes payable. This tells us that the business borrowed 200,000 from its bank on July 1st, 2024, and there was an effective interest rate of 6%. The principal of the loan must be repaid in 4 equal principal payments over the next 4 years, with the first payment due on July 1st, 2025. We have to record the journal entry required on July 1st when we got the loan, and any adjusting entry at the year end. So even though this is a notes payable question, it kind of also seems like an adjusting entry question. So it's fairly simple. When we borrowed the money, we debit cash because we received cash, and we credit bank loan. And the amount is 200,000. This is on July 1st, right? Now we are at December 31st. So let's count how much time has passed. July, August, September, October, November, and December. That's 6 months. So the year end, we've accrued 6 months worth of interest. So let's see what the annual interest is. Interest rate is 6%, so it's 6% of 200,000. So, which is 12,000. Now this is the annual interest. We need 6 months of interest. Oops. So the 6 month interest is 12,000 into 6 divided by 12, which is 6,000. So we have to set up the journal entry for this. So that's a debit and a credit. The debit is interest expense. And the credit in this case would be interest payable. So since we know the first payment is on July 1st, it'll be July 1st of the next year. So right now we haven't paid off the amount. We've only incurred it. So let's make 6,000. This is what our journal entry looks like. It's fairly straightforward. We'll do the parts regarding amortization schedule a little later. Now let's go to the next one. So this is a question related to the amortization schedule. So let's go ahead and create one. So we've taken out a 3% 6-year, $300,000 loan. The loan is repayable over the next 6 years with equal annual payments. So this is the total payment of 55,379. So let's go ahead and create the amortization schedule. This is what it will look like. You can put down date a year. You'll have total payment. You have interest payment. Then you have your principal payment. And lastly, we are keeping track of the balance of the loan. Okay, so the first entry will be when we've taken out the loan. So that is on December 31st, 20x4. On December 31st, 20x4, we've taken out the loan. So just ignore everything and let's put down the balance. So that is 300,000. So now, once we reach December 31st, 20x5, we incur a first payment. So the total payment amount that we are told is 55,379. Out of this, let's find what the interest payment is. So we are told it's 3% interest, so it'll be this into 3%. So 300,000 into 3% gives us 9,000. You know how much interest we are paying. And at the same time, there's a principal payment involved with this. The principal payment will be the total payment of this minus this amount. So let's see how much that comes to. 55,379 minus 9,000 gives you 46,379, which means from the balance, we subtract the principal payment amount. Remember, the principal payment is the amount that goes towards repaying the loan. The interest payment is the incentive that the borrower gets for giving you money. So that's the amount the other person earns. And the principal payment is the amount that goes towards repaying the loan. So let's see how much the balance is. So the balance of the loan will decrease by principal payment. So that's 300,000 minus 46,379, which gives you 253,621. Okay, let's go ahead and see for the next year. So now we're in 20x6, December 31st. Again, our total payment is the same, 55,379. Our interest payment, so it's again this into 3%, 253,621 into 0.03, which gives you 7,609. I'm just going to round them up. You can take it to 2 decimal places. You can probably round up. The question might tell you what to do. Now let's see what our principal payment is. So again, our principal payment is total payment minus the interest rate. So 55,379 minus 7,609 gives us 4,770. Now let's see how much balance is left on the loan. So how much ever the last balance was minus the principal payment. Which gives us 253,621 minus 47,770. 205,851. Now let's go to the next year, 20x7. Again, our total payment is the same. Let's see what our interest payment is. So this into 3%. So 205 into 0.03 gives us 6,1755. Let's call it 5. Okay, now let's see what our principal payment is. It's 55,379 minus 6,1756. Oh, sorry, I'm going to do that math again. So 55379 minus 6176 equals 49203. And the balance amount is the balance minus principal payment. So 205851 minus gives you 156648. Now let's go to 20x8. In 20x8, again, our total payment is 55379. So interest payment is this into 3% into gives us 4699. Now 55379 minus 4699 gives us 50680. So let's see what our balance comes down to. 156648 minus gives us 105968. Now next 20x9. So basically this keeps going on and on until we have 6 payments. After that, the loan will be entirely paid off. You can skip to the next part if you don't want to sit through it, but I will just create it really quickly. So again, 55379. You can check your answers afterwards. 105968 into 3% gives you the interest amount. 3179. 55379 minus 31. I'll just skip ahead to what the end result looks like. So this is what the end result looks like. We created the table. At the end of it, our balance reaches 0. And just again to reiterate, you set down how much ever the total payment is. You find how much interest rate is incurred by multiplying whatever balance was there by 3% by how much ever the interest rate is. Subtract from the total payment the interest payment. That is how much goes towards repaying the loan, the principal payment. And at the end, find the balance remaining, which at the very end will be 0. Now, because of rounding up, there might be a slight difference and you may get like $2-3 difference, but you can just put 0 at the end and that much just comes down to a rounding error. So this is what a repayment schedule looks like. Now, next we're going to a question about provisions versus contingencies. Now, the main difference between the two is for a contingency, we will put down a note under financial statements. However, for a provision, we have to put down a journal entry for how much we estimate the amount will be. So for each of these questions, only pay attention to what the legal counsel says. It doesn't matter what we think. It doesn't matter how much we are sued for. It doesn't matter how much what our friends think. The only thing that matters is what legal counsel thinks the amount will be. So situation A. Now there are a couple of steps that we'll be going down. So let's see what the steps are. So first of all, ask yourself, is this obligation as a result of past events? So that will always be a yes. So there will be some event that's happened. Next, does it have a probable outflow? That means, do you think you'll be paying out some amount or not? Next question you ask yourself is, can you actually measure how much of that outflow will be? After you ask these 3 questions, which basically comes down to just 2 questions, which is probable outflow versus is it measurable or not? So for each question, we're basically asking ourselves the question, is there a probable outflow? And is it measurable? So let's go ahead and check the 3 cases. The first part tells us that a customer slipped on the floor that had been washed and was seriously injured. The janitor did not put up a yellow warning sign that the floor was slippery, and the whole episode was caught on tape by camera. The customer is suing for $500,000, but legal counsel estimates that the amount of the settlement will be $100,000. So the first question, probable outflow, yes. Our legal counsel tells us that we are going to have to pay out something. So the next step is, do we know how much we're going to have to pay out? Yes, legal counsel tells us it'll probably be $100,000. So this means it's a provision. We have to set aside a provision for this. So let's go ahead and do that. So there has to be a journal entry involved. So debit credit, this is a provision. Now your debit just has to indicate that you understand some kind of an expense, some kind of a cost. You can call it legal costs or provision expense, something that indicates that you know there is an outflow. Secondly, a credit has to be some kind of a liability. So you can call it provision liability. Okay. And now the amount is $100,000. Great. Now let's look at this next question. It is fairly similar to the first one, but with one key difference. So now it tells us that a former supplier is suing a company for $1 million for breach of contract. Legal counsel has reviewed the case and determined that there's only a possible but not probable. So most likely you will not have to pay something, but there is a chance that you may have to pay damages. And the amount right now is highly uncertain. So we are not sure how much amount is going to be going out. So what this means is, for the first answer, is there probable outflow? Not necessarily. So there may be a probable outflow. But is it measurable? No, we have no idea of how much that amount can be. Again, what matters is how much amount the legal counsel tells us. So obviously this means this is a contingency. And we just need to include a note under financial statements. Next part tells us that an employee is suing us for $150,000. Legal counsel is of the opinion that more likely than not, we'll end up having to settle some amount between 60,000 and 80,000, with each amount being equally likely. So again, probable outflow, yes. More likely than not, we're going to have to be paying some amount. And do we have an estimate of the amount? Yes, it's between 60,000 to 80,000. So at times like this, we understand that this is a provision because we're going to have to pay something and we have an idea of how much it is. But now the amount that it will be a midpoint between 60,000 and 80,000, which if you average the two comes to 70,000. So let's write down our journal entry. Again, debit, credit. Your debit will be some kind of an expense. So let's call it legal cost. And your credit has to be provision liability. And the amount will be between 60,000 and 80,000. Take a midpoint, take 70,000. Great. Now this next question is again similar to this one, but with one key difference. It says that this competitor has sued your company claiming that you violated a patent. Legal counsel believes that more likely than not, you'll have to settle for some amount. But it was impossible for legal counsel to estimate the amount, with all outcomes in the range being equally likely. So the answer to your first question, probable outflow, yes. The legal counsel says that you'll almost certainly have to pay something. But do we have an estimate of the amount? No. So we can't set down a provision because you can't set down journal entry for just any amount. So since you don't have any idea of what the amount you'll be paying out is, this ends up being a contingency. And we just need a note under financial statement. So that's provision versus contingency. Let's go down to employment insurance versus CPP and income tax payable. So it's payday for the employees. The total gross salaries came to 9,995. And part of those were deductions. There's CPP, Canada Pension Plan, there's employment insurance, and income tax, which we'll be collecting on the government's behalf. So all of these are liabilities because all of these amounts we are going to have to send to the government thereafter. So let's see what the journal entries look like. Now remember, there are two portions. There's the employee portion and the employer portion. So let's do the employee portion first. So if the gross salary is this much, and these deductions happen after that, that means that the net salary that the person is going to get in hand is this amount minus all of these deductions, right? Let's see how much that comes to. So that's 9995 minus 976 minus 645 minus 1575. So the cash in hand that the employees are going to get is 6979. That is how much cash we'll be paying out. So let's set up our accounts. So we know there's a credit for cash and the amount is 6979. At the same time, we've collected CPP. So there's a CPP payable, which we have to send to the government. And that amount is 796. There's also an EI payable. And that amount is 645. And the last one, we have an income tax payable of 1575. Now, what is our debit in this case? We are paying the our workers. So this is a wage or salary payable. Sorry, expense, wage or salary expense. And this amount will be for the gross amount of salary that we are paying them, which is 9995. Or simply add up all of these numbers and you'll get the same amount. This is the employee portion. Now let's go ahead and do the employer portion. So we'll obviously have a debit again to wage expense. And our first credit is to CPP. So when it comes to the employer's contribution, we match how much ever CPP the employees put in. So CPP payable, 796. We are matching this amount. Then we have to match EI payable. And that amount will be 1.4 times how much ever the employees put in. So we take 645 multiplied by 1.4. That gives us 903. This is how much the employer has to put in. So the employer has to put in more than the employee. And now we just add these two amounts, and that is how much our wage expenses. 1699. This is what the journal entries look like. It's fairly straightforward. And again, liabilities is fairly easy. It's straightforward. There are only limited number of journal entries. Just remember, we match exactly how much CPP the employees are paying and 1.4 times the EI that the employees are putting in. With that, we've completed the liabilities portion. See you for the next one.